Markets have been hitting all-time highs on the promise of cooling inflation, the eventual rate relief from the U.S. Federal Reserve. But are corporate earnings actually justifying these valuations? Joining us now to discuss, Damien Fernandez, Managing Director and Portfolio Manager with TD Asset Management. Damien, great to have you back on the show.
Always a pleasure, Greg.
We have been obsessed with inflation, with rates, what central banks are going to do next. It ends up in every story and narrative about the markets. But fundamentally, how are things looking? Well, what are the earnings telling us?
Well, the earnings, we've been in earnings growth and earnings bull market since last year, Q2 last year. So let's put some numbers to that. Q2 of 2023 was the decline, the bottom in earnings. Earnings were negative. And every quarter since, Q3, Q4, Q1, the remaining quarters expected for this year, we've seen earnings growth. Like you talked about at the start, the market's so focused on these narratives, these big macro narratives about what's happening with inflation and what are rates doing and geopolitical risk. We're in a bull market in earnings, and hence it's, keep it, the Occam's razor approach. It's like the reason markets are at new all-time highs is because earnings are at new all-time highs.
Can we just show the audience a historical earnings trend chart that you brought along? Maybe we'll throw it back up there again. Sort of tell us what we're looking at here and what these bars are telling us.
Sure, like you can see that right there. Right? The top half of that is sales and the bottom is earnings. And I've just kind of highlighted how earnings were negative last year. And ever since then, we've had progressive sequential earnings growth. And so I guess at this point, right, when the conditions that are supportive for markets, falling inflation, rising global activity, earnings delivery, I'm not surprised. I think we're having a very conventional bull market.
The other narrative that has been commonplace in the market is, yes, we saw the S&P 500, the NASDAQ hit new highs, day after day, week after week. It's all been about tech. It's been about a handful of stocks, and we don't got the market breadth. What is that looking like?
Like last year, it was about that, right? Last year, the acronym Magnificent Seven, it did hold water. What I mean by that is that I showed you the earnings chart last year. The first half of last year, we had an earnings recession. So what normally happens in earnings recessions is that the market gravitates to the places where you actually see growth. Last year, the only game in town was the Magnificent Seven because through the secular benefits of AI, which was moving up their top line and earnings. And so you did actually see pretty strong earnings growth in those names. And so you had a collection of investors moving towards that. This year, it's been the Magnificent Seven is no longer monolithic. There's, two of the seven are underperforming the market, and while the rest are holding in, there's much more breadth, right? My term, like last year, you had bad breath, and by that I mean like the market just didn't see the same participation. You had a lot of markets you had a lot of stocks that were up, they just weren't up to the same degree as the Magnificent Seven. This year, you're just seeing the average stock in the S&P is up. And the Mag 7, some of them are lagging. Last year, there was the narrative that we're having a very unconventional market, right, that's led by the Mag 7. I thought it was actually pretty run-of-the-mill. And what I mean by that is that in the early stages of a bull market, what normally leads? Early cyclicals lead. Semiconductors, housing stocks, media, all of those sectors had actually bottomed all the way back in, late 2023. As economic growth progresses and people are more comfortable with the recovery, you start seeing this transition from early cyclicals to mid to late cyclicals. Financials are really high on that list because one of the biggest benefits for financials if you don't go into recession is you have better loan loss or lesser loan loss provisions. So financial companies should start seeing earnings growth, plus net interest margins are stable and are improving. I think financials and you have below market valuations. Industrials are tied to the secular theme that I'm pretty sure many of your guests are talking about related to AI. And I guess tied onto that is utilities, because the 40% of incremental energy demand in the US is now going to come from these data centers. And these data centers are energy hogs. And so if you're a utility that can provide energy to them, you should see a pretty significant uplift. Utilities have also been beaten up, so there is a valuation argument there too.
If we're talking cyclicals, early cyclicals, late cyclicals, where we are in the economy, some people start thinking, okay, the S&P 500 obviously has had a pretty great run. The TSX Composite Index, could it play catch-up?
I think the TSX too is, think about the TSX and what comprises our biggest sectors. The composition of the TSX, the last time I looked, it was over 60% is between financials, energy, and materials. those are all, by definition, late cyclical sectors, right? They're not beholden. They're all beholden to what's happening in commodity prices, what the Federal Reserve, central banks are doing, what's happening with growth in China. And so all of those sectors, what normally happens if people are more convinced about an economic recovery, commodity prices start getting a bid. Like energy is $75 today, WTI, it was $75 last year. Hard for energy companies to make money when they're, what they're beholden to, the price of what they sell is below. But if the recovery ensues, you should start seeing more of these commodity prices hopefully, catch a bid, and that'll be beneficial to these late cyclicals. I could actually see.
We started talking about earnings growth, right?
Yeah.
I believe you bought a chart too,
I
showing
love
S&P
charts.
500 and TSX earnings growth.
I think charts sometimes just convey a lot. And this is pretty simple. The white line is the S&P earnings from the last 5 years. They've grown, they've outpaced the green line. The green line is TSX earnings. The reason the S&P has outperformed the TSX is because earnings growth has been faster in the S&P. TSX earnings are actually below where they peaked all the way back in 2022. And that's because commodity prices benefited at that time from geopolitical conflict, and then oil prices have come off, and that's why the green line has fallen. But if commodity prices continue to increase as people are more convinced about economic growth returning, you should start seeing that play catch up. So I wouldn't be surprised if a year from now we see the TSX actually doing much better.
I want to get your take on the inflation print from this morning. Clearly the markets are pleased. It seems like the Goldilocks scenario that people have been waiting for, that you could raise the cost of borrowing, you could tame inflation, not do too much damage to the economy, and then you're back off to the races again. Is this how we should be reading this, or is there some skepticism?
I think, look, we're having the most interesting thing about why markets are bid today is that inflation can fall for two reasons, really, right? It could be demand. Demand actually collapses, and that leads to like disinflationary impulse, or you have a supply improvement. What we're seeing is actually to the benefit, and I'm pretty sure the Federal Reserve and the Bank of Canada are rejoicing on this, is that we're having good disinflationary trends. What I mean by that is that the disinflation we're seeing from 9% inflation back in 2022 to 3% today has been supply driven. Right, more supply of labor, more supply less cost of goods, and I think that continues. These are very. I'm not surprised why the market is up today. You had the inflation print was supported by really good underlying inflationary pressure, particularly from housing, which people were waiting for to actually turn, and that's coming that way. So this probably, I think the Federal Reserve is on track for 2 rate cuts this year. The Bank of Canada's already started. Look, we're in, we're past peak. If I think about rate mountain, all central banks globally, scaling up the rate mountains, we're on the other side of that. The Bank of Canada, the ECB, the Swiss National Bank, they've all started cutting rates. The Fed's on track to do so. Those are generally, if growth is stable and we're cutting rates, that's supportive for equity prices globally.